Welcome back to Factful Finance, where we uncover the truth behind your financial success. Now, here's a question for you. Have you ever wondered how an economic crisis can reshape an entire financial market? It's more than just a slump in the economy. The ripple effects of these crises can alter investment strategies, government policies, and even your day-to-day finances. Today, we're diving deep into how these turbulent moments impact financial markets. More importantly, how you can turn this knowledge into a strategic advantage for your own financial journey. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance. Now let's break this down. When an economic crisis hits, the immediate reaction in the markets is often a sharp decline in stock prices, with investors scrambling to minimize losses. But what happens next? Well, that's where it gets interesting. Take the 2008 financial crisis as an example. In the aftermath, global financial systems were severely shaken, but rather than all markets staying in decline, they experienced a series of shifts. Many industries that were once considered stable, like real estate and banking, saw massive restructuring. And as a result, entirely new investment opportunities began to emerge. Those who understood the underlying changes were able to capitalize on those opportunities, while those who didn't were left reeling. So, what exactly drives these market shifts during a crisis? First, let's talk about market liquidity. During economic crises, central banks often step in to inject liquidity into the market, making sure money flows to businesses and financial institutions. This helps prevent further collapse. But what this also does is create new dynamics in the bond and equity market, especially in the way risk is priced. Essentially, investors shift their portfolios to include safer assets, like government bonds, which traditionally carry less risk during periods of uncertainty. However, it's not just about playing it safe. Crises often lead to innovation. Think about the tech sector in the wake of the 2008 crash. Companies like Facebook, Amazon, and Apple, although already well established, leveraged the crisis to enhance their digital services, making them more indispensable to consumers. This illustrates how the right investments during turbulent times can sometimes offer long-term rewards that reshape the market landscape entirely. Now here's where it gets personal. You can leverage this market knowledge to make smarter investment decisions. When financial markets are rattled, the knee-jerk reaction is often to sell off assets. But what if you took a different approach? Rather than panic selling, consider this. Is this crisis creating opportunities to buy into assets that are undervalued? Take Emma, for example. In 2008, she decided to shift her investments into tech and emerging markets, while others were selling off stocks in fear. Over the next decade, her portfolio grew by 35%, thanks to her ability to recognize and capitalize on opportunities in a post-crisis world. You don't need to be a financial expert to spot these opportunities, but understanding the broader impact of crises on market structures can certainly give you an edge. During an economic downturn, prices fall, but they also reset. It's like a market-wide clearance sale for assets that have long-term potential. Understanding this dynamic means you're ready to buy when others are running for the exits. Economic crises are also responsible for changing government policies and regulations. We've seen sweeping reforms in areas like banking and investment practices, all in response to the systemic failures during past crises. For example, the Dodd-Frank Act was passed after the 2008 financial crisis to regulate the financial services industry more strictly. These regulations reshape how financial markets operate, impacting everything from banking fees to how Wall Street firms operate. So, whether you're an investor or just someone trying to understand the bigger financial picture, it's essential to keep track of these shifts. By doing so, you can avoid common pitfalls during a downturn and potentially harness the unique opportunities that arise. But what about the markets themselves? How do they evolve? Here's the truth. Crises expose vulnerabilities in financial systems, but they also force growth. The market learns from the past, often emerging more resilient and efficient than before. Think of it as the financial world's version of Darwinian evolution. Only the strongest and most adaptable survive. Those who can read between the lines of government bailouts, market rebalancing, and innovation post-crisis will be better positioned to navigate the next downturn, whatever form it may take. As we've seen time and again, a crisis can shape financial markets in ways that seem chaotic at first, but ultimately lead to major growth and transformation. It's all about understanding the underlying forces at play and positioning yourself to ride the wave, not be swamped by it. Want more insights on how to turn financial uncertainty into opportunity? Hit that like button, subscribe, and leave a comment below on what aspect of market crises you'd like to explore next. If you found this helpful, you'll love what's coming next. Keep your eyes peeled for our next deep dive into financial strategy. Click the video on screen.